Wall Street firms are out for their forecast for the second half of the year, and it is very, very bearish. They collectively are expecting somewhere between a negative 10 to a negative 27% fall in the stock market. So are they right? Are they wrong? Where are they off? Stick around, I'll tell you. Hey everybody, RC Peck here with Fearless Wealth. And the main thing Fearless Wealth does is to make sure you are retired strong. To retire strong means protecting your downside and making sure your money is in the market when it is strong. And that's what we're going to talk about today. So here's the thing. Wall Street came out with their mid-year forecast, and it does not look good. The worst mid-year forecast is a fall of 27%. The best is about a fall of 10%. So they're all saying the second half of the year is going to look really, really, really bad. Now, here's the thing. We know what to look at. We want to look at a place where if the market is going to fall, we know that that certain asset class has to be doing something very specific. And if the market's going to fall, what is another asset class? So we're literally just going to look at two things today. So let me pop over to the charts. We're going to start with the first thing. And the first thing is a sector. It's the technology sector. Now, here's the thing about technology. It historically leads the market up or down, right? So if bad things are going to happen, it typically starts falling first and falling harder. The S&P fell 25% last year, and the technology sector fell 34%. So it fell much harder. Here's the thing, the technology sector just broke out to new lifetime highs. Look at this screen here. Let me just show you what I'm seeing here. So this is XLK with dividends reinvested, and it just went out to a new lifetime high this week. New lifetime highs are a sign of stability and strength. People don't like them. I get they don't like them. They have investment vertigo, like where the thing goes higher, they get more and more dizzy, like a dizzying height, like, oh my gosh, this thing's going so high, it's going to crash and fall by 80%. That's actually not how investing works. When something is in a stable direction moving higher, and when something is breaking out to new lifetime highs, especially when it's equities, that's a sign of stability. And that's what we're getting today. Technology has broken out to new lifetime highs. Now, this is technology with dividends reinvested, so that helps us get there sooner. The people behind technology is really everyone, right? Hundreds of millions of people, the richest hundreds of millions of people collectively are basically saying, yeah, get me a little bit more of that. I'll buy more of that. And that's a sign of bullishness. We're going to look at one more thing. Now, this is one of the biggest, I was going to say asset. It is an asset. It's the US dollar. It is the biggest currency on the planet, and it's one of the biggest, symbols, assets on the planet. It's the US dollar. And no, it's not going away. Sorry, everybody. It just broke to new lows for 2023. Just broke down to new lows. And I think it continues going, not in a straight line, but it continues moving. Now, this is what we know about studying market history. When people are worried, they buy the dollar or the Japanese yen historically. Recently, it's been the dollar. The dollar was where people panicked in COVID, and the dollar is where people panicked in 2022. That's not happening right now. In fact, the dollar is falling. So people are moving money out of the dollar, and they're, wait for it, moving their money into equities. I'm not saying buy tech. I'm simply pointing out that tech broke out to new highs and the US dollar is breaking down. That is a sign of bullishness for the equity market, right? That means more people want to be in it than are in it right now. So I think the second half of 2023 is actually looking very bullish. Now, I do not forecast. I think Wall Street firms are expected to make forecasts. And if you notice, they all make the same forecast. They always have to bunch together like little 5-year-old girls and boys playing soccer. It's kind of bunch ball. They just all stay together. It's the same thing with Wall Street firms. So that's what I'm seeing. I'm actually seeing a bullish second half to 2023. And what's great is when you know where to look, there's a level of clarity, there's a level of stability, there's a level of appropriate confidence when you know where to look and how to look. And that's what it means to retire strong, to have control back over your life, right? Even if you're not managing your own money, to have the clarity and the understanding of what is and is not working. So let's tie it together. Technology breaking out, there's other parts of the equity market that are breaking out too. And the number one, I'm really, really scared, I don't know what to do, but I'm just going to put my money here, asset is breaking down the US dollar. And that's what's happening. That's how I see it with the price charts. Let me know where you think I got it right, where you think I got it wrong. Like and subscribe, leave a comment. All those things help. I appreciate you being in my world. And if you're curious how replication is hurting your portfolio, yeah, replication. It is a very expensive strategy to have. Here's the thing, most people have it in their portfolios and it's costing them about $35,000 per year per million. If you want to know how much it's costing you, go down into the description and get on my calendar, and we're going to do what's called a portfolio x-ray. I think you might be surprised just how expensive and how much pain replication is causing your future. Thanks, everybody. I appreciate, again, you being in my world, and I'll talk to you soon.